Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about the accounting cycle, and it has been so much fun. We've done journal entries, we've done adjusting entries, we've done closing entries and trial balances, and talked about the financial statements, the accounting equations, all these different elements that make up the basic cycle that we go through every single period as accountants. The way we keep track of everything so that we have the bookkeeping information that we need and can create the reports and the other information that our stakeholders will use. The last thing we want to talk about before we wrap up this discussion isn't actually part of the accounting cycle. It's a necessary element. It's something that's part of these basic fundamental concepts. So it fits in really well here, even though it's not part of the cycle. What we're talking about is the cash conversion. Now this can happen both ways, where we've got cash information and we need accruals. Or there can be companies that have accrual information and need to get back to cash. It happens all the time. Remember that all publicly traded companies are required by the SEC to show not only accrual information, net income, balance sheet, but also a statement of cash flows that shows the cash flows of the company, what it is we spend our money on and why. In addition, small businesses often don't have the wherewithal to do accrual accounting. They keep track of everything on their checkbook. That's how their taxes are figured. It's just not worth it for a small mom and pop shop to do accrual accounting. So they don't. They do cash basis. Until eventually they go for that bigger loan and the bank says, no, we want accrual accounting numbers. And then they have to go back and put together an income statement and a balance sheet so that they can show it to the bank. So we need to be able to make this conversion. Whether we're accountants doing it for a business or small business owners that have to at least understand it for ourselves, or whether we're investors wanting to understand what the companies did, we got to be comfortable with these concepts. So we're just going to talk about this at kind of a basic level now. We'll talk about it more when we talk about the statement of cash flows. But we want to at least introduce what is involved in doing a conversion, either from cash to accrual or accrual to cash. There's actually lots of different ways that we can do this. Some people use journal entries, some people use formulas, some people use T accounts. Personally, I prefer a method that's called the Worksheet Method, and that's what I'm going to share with you. If this Worksheet Method really doesn't fit with you and your personality, you ought to check out an intermediate accounting textbook and see how they explain it. Maybe that way will work better. I think this way is really intuitive and makes sense, but not everybody likes it. In order to really understand the worksheet, the first thing we need to be comfortable with is the flow of cash through our business. And in order to do that, I'm going to have to invite you to step into my kitchen. I'm sure it probably seems strange that I've invited you into my kitchen to talk about cash flows. I mean, after all, we've been dealing with debits and credits and journal entries, right? What could we possibly do in the kitchen? Well, the reality is, in order to understand cash flows, you have to be comfortable with how cash moves through the business. And in order to do that, you have to have cash, so that you can see how it flows through our business. After all, we're trying to figure out cash flow, right? So let's assume that our investors have given us all of this cash so that we can build our business. Now, of course, we have to take this cash and divvy it out into the different assets we can use to make more money so that we can return this investment to our owners. So let's get some additional assets. Let's say that this is accounts receivable, and this will be our inventory. And here we have equipment, and this can be prepaid rent. 4 different asset accounts. Now, I want you to pay attention very closely. Do you see the level of cash that I have in my account, my cash account? Watch what happens as I invest in inventory. Okay, did you see what happened? Did you notice? As inventory goes up, what happened to the cash balance? It went down, right? The same thing happens as I invest in equipment. The more cash I put into equipment, the less cash I have in my cash balance. Same thing, of course, if I put some money into prepaid rent by paying early, and if I sell to my customers on credit, well, as that accounts receivable goes up, they don't pay me. That's the whole purpose of accounts receivable, which means I have less cash. That's how it works. As my assets go up, my cash goes down. Now watch what happens as I sell off my inventory. Watch carefully. This is really important, okay? You see the level in my inventory account? and here's my cash, what happens? Well, as my inventory drops, my cash balance goes up, right? Same thing happens if I collect on my accounts receivable. As the accounts receivable balance goes down, cash goes up. And we could keep going, right? We could sell off some inventory, or excuse me, this is equipment. We could sell off some equipment too. And again, as my equipment goes down, cash goes up. Okay? So you can almost think of cash and the other assets in a business as a teeter-totter. You'll never forget your fat little accounting professor standing in his kitchen, going back and forth, talking about cash flows. It's an image that'll stay with you. As assets go up, cash goes down, because I've used that cash to invest in my assets. As those assets go back down, my cash account balance goes up for one of two reasons. It could be because I've sold those other assets, and therefore I have the money. Or it could be I'm simply using up those assets and not having to pay out extra cash. For example, this prepaid rent. If I use up this prepaid rent that I paid for last year, I have more balance in my cash account this year. Not because I got money, but because I didn't have to spend any money. All right? So it's a teeter-totter. As assets go up, cash goes down, and as assets go down, cash goes up. That's our teeter-totter. Okay? Now, that's not the whole picture of cash flows. We also have external financing. That happens all the time as well, where we buy from our vendors on credit, or we go to the bank. Right now, this time, watch what happens. As I owe more and more money to the bank, you see? The more I borrow from my investors or my creditors or even my owners, cash goes up, right? But eventually they're going to want me to repay them. That's the whole point, right? So let me move some of my assets out of the way so we can do this next piece. We'll move equipment and prepaid rent over here. So again, here's my liability, let's say, or my external financing, whatever kind it is. As I pay them off, give them back their money. It's not an asset in the business where I get to keep it. As I pay them back their money and it goes away, cash goes down. So just like assets were a teeter-totter, liabilities and equity, my financing, is more like the wave. As I owe more to my creditors or to my owners, cash goes up. As I pay them off, cash goes down. So creditors, liabilities, and equities, all of those different accounts, they work like the wave with our cash flow. So with assets, we've got a teeter-totter. With liabilities and equity, we've got the wave. And if you can keep those things straight, you'll be set for understanding cash flows. Now that we've gone through the flow of cash through a business, we're ready to start using the worksheet method. And we'll start doing that in our very next segment. I'll see you then.